I'm Carl Warren, and I'd like to discuss with you today our accounting cycle chapters of our textbooks, chapters 1 through 4, and the logic behind what we're doing in those chapters. Essentially, the key point is that students need to fully understand the accounting cycle. If they miss that early in the course, they're doomed. And so with that in mind, we designed our accounting cycle chapters very carefully. One of the things we did is we used one company throughout all the chapters. And our company here is Net Solutions. Then we begin with, in the first chapter, with November transactions, and we only have 8 transactions here, and we carefully design these transactions. The logic is that we want these transactions very simple, easy for students to understand, and at the end of that process, we want to prepare financial statements to introduce the financial statements in Chapter 1. So in our Chapter 1, November transactions, we have 8 transactions carefully chosen. Specifically, one of the things we don't do is show equipment as one of the transactions, the purchase of equipment. The reason we don't do that is at the end of Chapter 1, we want to introduce the students to financial statements. And if in fact we showed equipment, then we should have depreciation. And we don't want to show depreciation. That's too early, that's too complex a topic in Chapter 1. And so what we do in our selection of our transactions in Chapter 1 is we use land. Not equipment, but land. So we do have a fixed asset. And then we show financial statements in Chapter 1. We move on to Chapter 2, going from simple to complex, by starting in Chapter 2 with an introduction to T accounts and journal entries, posting, and development of the ledgers. Now, what we do in Chapter 2 is we review the Chapter 1 transactions. So we take the November transactions, the 8 transactions we had in Chapter 1, and we simply redo those in a different format. So we analyze the transactions again, but simply put them into different recording format to reinforce our discussions in Chapter 1. And then we jump into December transactions in Chapter 2 using debits and credits and journal entries. Now these December transactions are slightly more complex because in the end we want to be able to generate accrual financial statements. So we get into December transactions, slightly more complex. Again, we're going from simple to complex. At the end of Chapter 2 we have the unadjusted trial balance, simply to so students will understand that you have equality of debits and credits, and that's how we conclude Chapter number 2. Chapter number 3, we delve into adjusting entries. Now this is a very complex chapter, but again, we use the December and November transactions. All the accrual transactions essentially are in December, so we focus on the December transactions. The key thing that I want to emphasize in Chapter 3 is Exhibit 8. In Exhibit 8 in Chapter 3, we summarize the whole chapter. If the students can understand and work their way through Exhibit 8, they've got it. And then we conclude Chapter 3 with the adjusted trial balance. So we had an unadjusted trial balance in Chapter 2. Now we have an adjusted trial balance in Chapter 3. Chapter 4, we wrap up the accounting cycle with the financial statements and closing entries and a post-closing trial balance to make sure that we've closed the accounts properly. And then we review the 10 steps of the accounting cycle, which we've done from Chapter 1 all the way through Chapter number 4. Now, one of the ways we reinforce what we've discussed in the first 4 chapters is we have a capstone illustration at the end of Chapter 4. And this is a key illustration. Essentially, it's Kelly Consulting. And in Kelly Consulting, what we do is we start a business and we go through each of the steps of the accounting cycle. At each step, we review it, we review what we've discussed prior to it, and then apply the recording to Kelly Consulting. And at the end of that process, we have financial statements for Kelly Consulting. So what we've done here is we've used one company, simple to complex, chapters 1 through 4. We reinforce that throughout. Then at the very end, we have a capstone illustration, which if the students understand Kelly Consulting, they've got it. They've got it then. And then at the very end, also in our inter-chapter material in Chapter number 4, we have a comprehensive problem, which we take Kelly Consulting one more period. And so we give the students ample opportunity, the instructor ample opportunity, to really fully comprehend and understand the accounting cycle.